IMF now joins us exclusively. Welcome, David.
Good morning.
Nice to see
How are you?
Congrats on the position.
Thank you.
So we've got to start with the topic du jour. The Federal Reserve, most powerful central bank in the world, cuts interest rates for the first time in over a decade. How do you think about the global impact of that cut?
Well, you've had a parade of Fed watchers this morning, and I'm not going to join that parade. So let me give you a broader perspective. You know, the U.S. economy is still strong, with wages growing, with unemployment very low, business and consumer sentiment strong. But I think it's right to be focused on the fact that the global economy is sluggish, and that affects everyone. So I think it's proper that that's taken into account by the central banks in the world. We certainly want to see policymakers do no harm. The trade tensions, Brexit, these are phenomena that introduce uncertainty and are not good for the global economy. So it makes sense for the central banks of the world to remain accommodative and to be focused on achieving their goals.
So given the fact that you guys have just downgraded your outlook for the global economy yet again, and that trajectory moves lower, do you think the Fed will need to continue easing?
I think they have to see how the economy evolves. I think it's entirely possible that the major central banks of the world will be dealing with this sluggish economy for some time, and so there'll be a need to continue in an accommodative posture. But let me add that I think it's time for everyone to start being a little more vigilant about financial stability risks. You know, we've always said that when interest rates are low for a very long time, you get a reach for yield, and that's not become a dangerous issue, but we've certainly seen interest rates creeping lower. I think now in the Barclays Index, $16 trillion worth of bonds in the world have a negative yield, where even just last October that was only $6 trillion. Not only have the central bank rates gone lower and 10-year sovereign bond yields gone lower, but investment grade spreads have gone lower, and high yield spreads have gone lower. So the reach for yield is compressing spreads. It's no longer clear whether perhaps risk might come to be underpriced in a way that could lead to vulnerability. So I'd say it's not a time for supervisory or regulatory forbearance or easing. It's a time to be vigilant about financial stability issues while central banks are doing the right thing, which is focusing on their mandates and being data dependent.
Are you warning of bubbles?
Well, I wouldn't call it a bubble, but I think the way to think about it is that the reach for yield is leading people to buy instruments that then leads to compression of spreads. And the risk is a reversal if people are accustomed to are borrowing, accustomed to the very low spreads, holding instruments in their portfolios with very low spreads. A repricing of risk could then be a disruptive event. You know, whether right now we don't see this as a systemically dangerous situation, but you know, this kind of phenomenon can grow, can become more significant. So it's a time for vigilance.
You guys have also been really front and center at the IMF warning about the breakdown of trade activity and how that's weighing on the global economy, the impact of tariffs. I mean, can you just give us an update on how much that is slowing global growth right now?
You know, whether trade's a driver of growth or a conduit for growth, we can have a conceptual discussion. But the most notable fact is that in the first 6 months of this year, global trade is actually lower than the first 6 months of a year ago. So global trade is actually contracting, and that's not a good situation. It is probably a harbinger of sluggish growth that will accompany it. It's to an important, you know, it derives from a number of factors, but it is certainly affected by the trade tensions, and that potentially will be affected by technology tensions more and more as time goes on. So I think it's time for the countries involved to have dialogue, to reach agreement, to try to find a way through this, since the global economy is fragile. And that's, let me say, it's for both sides to find the right approaches, the changes in policies and approaches that will lead to agreements. But I think this is an extremely important moment not to do any harm, because after all, if we were to have a recession, I think we know that the world is in a weaker position to combat recession because monetary policy space has been used, fiscal policy space has been used. It would be more difficult to cope with recession, so it's best not to cause one.
Yeah, less ammo. I know you in particular, David, have been very interested in the intersection of technology and finance. Are you guys at the IMF looking into Facebook's Libra? And if so, what can you do about it? And what exactly angles and aspects of it are you looking into?
Yeah, we're spending a lot of time on this, and we have a paper that's just out that I would refer people to that came out 2 weeks ago. Our view is that there's a balance of opportunities and risks, and it would neither make sense to squelch the opportunities nor to ignore the risks. You know, these innovations, these financial innovations, including stablecoin concepts, could bring to transactions what the internet brought to information, which is to have transactions that are instantaneous, that are very, very cheap, and that are very secure. And that would be a benefit. It could lead to greater financial inclusion. It could mean you could make a payment to someone in another country that would happen instantaneously and be very cheap, where that's not possible. It is a challenge to incumbent financial institutions. These are opportunities. But on the other side, there are substantial risks. There are risks to a payment system that might become largely a private payment system. There are issues about how large any particular stablecoin might be and whether there be market power. There are risks of illicit activity happening. There are risks that if the payments are largely outside of existing channels, that monetary policy could effectiveness could be changed. So there are a host of risks. It makes sense to take a balanced approach to allow experimentation, but to be sure to guard against the risks over time.
Finally, David, just wanted to get your quick thoughts on Christine Lagarde. I know you guys are very close. I think it was described at a recent town hall as brother and sister close. I mean, what kind of challenge is she walking into at the ECB, which has slower growth, which has less policy ammunition, and which has much tougher politics?
Well, first, you're right. We all are sorry to see her go. She's been a great managing director. I think she's been the world's top economic diplomat. And I think our loss is the ECB's gain. I think the ECB faces a challenging time for the reasons we've talked about. That there are difficult economic challenges ahead. Monetary policy can contribute, but it's best not to over-rely on it. You need a central bank governor who can deal with all of the different things that might happen, but who can also help enunciate for Europe how to muster all the available policy instruments in the event that there's a slowdown, how to cooperate and to deal with that effectively. And I think she's the person for that job.
David Lipton, thanks for joining us.
Thank you.